the market moves in phases, okay? And to keep it very simple for today, we're going to focus on this. While the market is consolidating in a specific area and it's just going sideways, I'm sure you've heard it before, consolidation, right? As the markets just don't know which way they're going to go and they go sideways, okay, this is what is happening. The markets are going sideways, and two things can happen, okay? As we consolidate, either we are going to expand to the downside or expand to the upside, okay? But the thing that I want to focus on today for those the market cycles, the phases, okay, is really what is going on. Now, in order for price to move a pip, a point, there's got to be enough shares physically owning something, enough contracts. We're talking about Forex. There's got to be enough purchases to move price from one side to the next. Now, what does that mean? Well, as time goes on, and the market is just consolidating, as time goes on, a lot of opinions are being formed. Okay? And these opinions are constantly coming into the order books. Okay, now, eventually, during consolidation periods, there could be too much supply and not enough interest. Okay? And if there's too much supply of something, now remember, we could be talking about the stock market where there's too many shares and there's not enough interest in buying those shares. In the crypto market, there's too much cryptocurrency, digital assets, whichever one we're talking about, being sold, and there's not enough interest. There's not enough interest in buying contracts and Forex. There's not enough interest in buying commodities like physical metals, gold and silver, barrels of oil. If there's not enough interest in something, price will eventually start breaking down because there isn't buying happening. Okay? We call this accumulation or distribution. When the market is consolidating before the mark up or the mark down or the expansion of price. Now, if there's not enough interest to keep price up, there's not enough interest in buying or accumulating, price will break down. Now, on the flip side, if there is enough interest, if price or these shares or digital assets, if something is being accumulated and people are wanting to pay higher, they have the willingness to pay higher, price will expand. Okay? Now, distribution. Okay, I'm going to mark it up here. Okay, because it's the same thing as accumulation. Distribution, or to sell. Accumulation, or to buy. Okay, accumulation A, distribution D. These are your two important phases to play in and understand. Now, during this time of accumulation, When the markets are going nowhere, investors are pretty much even. We can call it that. Investors are even in buying and selling. Okay? You gotta remember and you gotta understand. When we're talking about Forex, the supply is contracts. When we're talking about stocks, the supply is shares. Okay? And in order for price to move up or move down, you got to remember it's not just you in trading. There's millions of opinions out there. And how the price moves is, are people willing to pay more? So what they're doing is they're fighting over each other, right? I'm willing to pay $1 more. I'm willing to pay $1.50 more, $2 more. Okay? Maybe there was certain news that has struck the media and it's creating people's opinions to favor that investment. Okay? They start trying to topple over each other and buy. Well, what that's doing is that's decreasing the supply at certain prices because there's not an infinite amount of contracts, of shares, stocks, cryptocurrency, it doesn't matter. And the laws of supply and demand, when there's too much demand of something and not enough supply, price goes up. When there's not enough demand and too much supply, price goes down. When the demand and the supply is even, you get accumulation and distribution phases. Okay? So remember, for price to move down, think about it. Think about people, okay? They're trying to sell something and they can't. They get impatient. They're trying to sell something at $10 and they can't. They're getting impatient. So what do? They mark it down to 9, thinking that they're going to try to be able to sell something. Not enough people are buying it. Their orders are not being filled. So they move down to 8. Okay? Vice versa. People are buying whatever we're talking about. Right here, we're on USD JPY. Let's talk about USD JPY. People are trying to pay for the price that it's at. Let's just say $8. Well, the supply goes quick. Now we end up moving up to the supply of $9 because there's people out there with opinions that are not willing to sell unless someone is willing to buy it from them at 9 or buy it from them at 10. Okay, in these order books, there's supplies of contracts everywhere at every single number. Okay, and so the markets move at phases. Okay, this is how the markets will move from one point to the next. The willingness to pay for something, or the willingness to not pay for something until it gets down to a certain price because it's overvalued. Okay, so let's talk about accumulation. Okay, and I've got a lot of examples that I'll be showing you. But accumulation, eventually, the supply of contracts in this accumulation are all being bought up. And when that happens, okay, I'm sure you've seen this pattern before on Google. Okay, when this happens and the supply of contracts, the supply of commodities, cryptocurrency, doesn't matter. Eventually, when the supply is all bought up, price will start breaking out. Okay, price will start breaking out and it'll go higher until eventually no one is willing to pay at such high pricing. And when no one is willing to pay at such high pricing, guess what? The price starts going sideways again. Okay? And imagine the people that bought it back in here. Maybe some of them took profit. Some of them took profit. But eventually you stop seeing that whatever you bought is going higher in pricing and it starts stalling out. Remember, this is a chess game. You want to understand everyone's perspectives in the markets. When price starts going sideways, eventually people that bought maybe in here, maybe in here, maybe in here, maybe they were trying to sell their position up here and they never got it. And so now they're waiting to take profit off that certain position and it's not hitting their area. So what do? They start moving price down, trying to get their take profit filled, and eventually it happens. But then you have other people that are also trying to take profit. You've got other people that are also trying to sell. Eventually, there's too much supply of selling happening. Too many people trying to take profit. Too many people are trying to get out of the markets. And so what happens? Price starts breaking down. And overall, in the scheme of things, this is how the markets move. Something like this. The markets are accumulating. Okay, they're making lower highs, lower lows, higher highs, all in these small time frames. But on the bigger time frame, it's making accumulation. It's just going sideways. It's just consolidating. Okay, eventually there's enough supply that's been bought up and the demand is strong enough, so higher pricing starts happening. Maybe news is saying a bunch of positive things to make people pay higher in pricing until eventually it hits its peak to where it's failing to price any higher. Just like it says, last point of supply, sign of weakness. Eventually, there's not enough buyers and price will start breaking down. But how do you use this knowledge to really help and see where to take entries? Well, let's focus on accumulation. Okay? Now, remember, the markets move in phases. Okay? The markets are allowing time to pass. Because when time passes, pending money is being placed everywhere. Okay? Whether you've got people trying to sell, stop losses above the high, people trying to buy on the breakout, buy stops above the high, people are trying to buy at the W, stop losses below the low, people trying to sell the breakout, sell stop below the low. And it's time, and the more time that passes, and the longer price has stayed in the same area and consolidated, made a range, the more pinning stops that are everywhere, the more sell stops, the more buy stops, the more stop losses, because price has hovered around the same area. Well, this is what big money needs. This is what smart money needs to play. Backtest this. Backtest this one specific thing. Before price really expands, whether it's to the downside, whether it's to the upside, the majority of time, it will not expand, leaving such equal highs and just reject. So easy. It will not leave such equal lows before expanding. What will happen is that time will pass and money will accumulate here. Time will pass and money will accumulate here. Because remember, everything is a buy or sell. It doesn't matter if you're being stopped out. It doesn't matter if you're taking profit. Obviously, when you're trying to get to an order, it's going to be a buy or sell, but everything is a buy or sell. So what's pinning in these areas, because of people's opinions, is a supply of contracts, that supply of money. And so when you go and you back test, like I can see it just by looking at all of this. And you'll be able to see it too. You'll notice, okay, and I'll keep it just right here. You'll notice that before price really impulsively expands to the upside, to the downside, what happens is a rapid high will get created and then it'll reverse. Or a low will come in and then it will reverse. Why is this happening? It's because eventually you get to a point in your career where you have to worry about this thing called liquidity, this pool of money, in order to get your positions filled. And so when price comes up into where the pool of money is and reverses, this area right here, which we call the upthrust after distribution, because distribution is happening when market is going sideways, and that upthrust after distribution is freeing up all of the pending orders in here. Some people are being activated for buys, getting hit on that buy stop. Some people are being activated to be stopped out of the markets. First they sold, now they're being forced to buy. But what's happening is that both sides are being forced to buy, whether you have a buy stop or a protective stop loss. And so what's happening is this is allowing big money that's jumping in right here to get their orders formed or their orders filled. And the same thing happens on the other side. Price will break down before going up. Same thing. You've got support traders. Maybe they saw specific candle formations in here. Maybe they saw specific candle formations in here. But the understanding, 61.8, rejection, something. The understanding is that their stop losses are under here. Sell stops are under here. And when price goes into that area, it's freeing up all the money. People that bought too early are now being forced to sell back their position. Sell stops are being triggered to get into the sells. But what this does is this allows big money to get into position. Okay. Now this is what it looks like in a more detailed format. Okay. In phase A, what you're doing is you're seeing signs of buying. You're seeing, looking for signs of exhaustion. Okay. Eventually, price gets so exhausted that it explodes the other way. Okay, which is the automatic reaction. Don't really focus so much on the meaning of these letters. What I want you to do is just focus on keeping it easy for now. Here's the W. What kind of money is getting formed underneath? Did this take a while to form? Because remember, the markets are all fractal. I can show you accumulation on the 1 minute time frame, and I can show you accumulation on the weekly time frame and anywhere in between. But it's the understanding, is there enough time that has passed in order for big money to get their orders filled? Because from my experience is when consolidation is happening, accumulation at extreme areas, okay, maybe way below a obvious low on the daily, weekly time frames. Price hovers around that area and then dips below the obvious lows where everybody would put stop losses under. But what that is a big area for where big money can come in. The ones that have to worry about getting their orders filled, that's where they trade. That's where they play. And so to keep this simple is just think of your support traders. Think the W traders. Okay? Because during this time, what we can see are institutional candles formed somewhere in here. Institutional candles formed somewhere in here. Institutional candles formed somewhere in here. Because all those institutional candles are doing is showing you that big money is getting into position. That big money is wanting to see an expansion to the upside. And that's when patience comes into play. Okay, so to keep this simple, wait for the W, because that's where you know money is going to be formed underneath. And then wait for them to take it out. Because the markets will not impulsively move unless it's being sponsored by the large players. Now let's look on the other side. Distribution. In phase A, as you're moving up, eventually you see where the market starts showing signs of exhaustion. It's not willing to go up anymore. People are not willing to pay higher pricing anymore. So what happens? Starts consolidate. Okay? But the same thing that we're doing for accumulation, we're doing for distribution. Markets become exhausted. You're seeing your first sign of exhaustion, your first sign of sellers coming into the market. Eventually, you'll see that giant sell-off. You'll see times of exhaustion and you'll see a giant sell-off. That's that automatic reaction again. You'll see the giant sell-off where a bunch of sellers come in and then you'll get a bounce from it. Now, eventually, time passes, people's opinions start forming. You start seeing obvious M's. But what I want you to pay attention to is remember this. Remember, those giant impulse moves don't come until they take out popular stop losses, popular placement of those pending orders. Oops. And what you'll notice is that even M's will be formed, or in this example, a higher high will be made. And more likely, a higher high will be made with a giant wick, because huge obvious wicks will generate buy stop, sell stops, or stop protective stop losses above them or below them. Okay, but to keep this simple is look for the M, because money is being formed above it, that liquidity. Okay, and so big players, as time passes, big players will wait to distribute the rest of their holdings above that M, above where that pending orders will be. Protective stop losses, buy stops. And then we'll have institutional candles being formed all in here. And that's what we're looking for, because large players need to form liquidity in order to get the impulse moves, in order to fill their positions. Okay? So let's look at this. With Wyckoff Logic. As you can see, we had a W formed, the W taken out, and two possible areas to play. Same thing with distribution. There was an M formed, and then two possible play areas. Now, the reason why I love the knowledge behind accumulation and distribution is because I do not believe there is an accurate way of predicting the middle part. We don't know how far something will expand. Okay, whether it's to the upside or the downside, we don't know. But what we can do is read price action to where market is distributing or accumulating, and we can read the candles in these phases to know if prices, or if big orders are being bought or sold, and we play off them. Okay? Now, let's actually see this in charts. So the one thing that I wanted to for y'all to backtest was this kind of stuff. Right now we're on the daily time frame, but notice how price breaks down. Notice how price is breaking up. Notice how price breaks down, it creates equal highs and then goes above it before breaking down. Notice how before price breaking down, it explodes through obvious highs again right here. Notice how before price goes the other way, equal lows are formed. Price dips underneath equal lows, reverses. Notice how equal lows are formed. Equal lows are formed. Price explodes through not one equal low, not two equal lows, but the most obvious of obvious equal lows before reversing the other way. Okay? Think about what's happening. We're creating opinions. Okay? Not only are we creating opinions for buyers, also for sellers. Okay? Liquidity. Okay? Liquidity is always being represented by my dollar sign. Liquidity doesn't only have to be used for purchasing up orders, okay, just like it is down here. These equal lows, the very obvious equal lows down here, but it can also be used to support a markup. This whole move, okay, because remember, everything is buying or selling. When price moves over these areas, think about all the sellers. Think about how long they can hold being put in drawdown before getting out of position. And then when they get out of the position, they're buying back their position, pushing up price even higher. Okay? But if we were to label this, okay, phase A, you start seeing signs of buying happening. Okay? You've got your PS, that primary support, that first sign of exhaustion coming in for buying, the automatic reaction, right? The seller's test, testing that first climax. Okay? Think about another one happening. You have another secondary test in phase B. But don't be so caught up in trying to make Everything's so clean, picture perfect. The most important thing is being able to identify where's the money. Where's the money? Where's the money? And then price gets manipulated on a Friday when the markets are closed, after you see a doji candle, to get pushed down, gap open underneath here, and there she goes. Because liquidity is very important. And so understanding these phases, because as you can see, a month passes, allowing people to form opinions, to put protective stops everywhere before price dips right below equal lows and then starts flying upwards. Now let's look at another one. What do you have? We've been going in a downtrend for a while. Price has passed underneath obvious lows. And you start seeing points of rejection. You see it again. Lows, lows, an obvious W. What's being formed underneath here? Stops. Sell stops, protective stops. Okay, now really look at this for a second. When you see all of this, and I'll hide it, but when you see all of this and you know accumulation is happening, literally we're not going anywhere. Price is just going sideways. When do you really start seeing the buy? Like looking at this example right here, when do you really start seeing where buying starts taking place? And you can read it from the candles. Like if we were to highlight every single bullish scenario, okay? When does it really start buying? When does buying really start happening? And you can read it from the candles. Okay? Well, here's the low. Okay, phase A and B. Phase C. All in here. Notice this. Okay, because remember we highlighted all the buying. Look how bullish this buying looks compared to everywhere else. Nice, solid, huge up moves. This is phase C. Institutional candle. Okay. And so phase C, the spring. Really look at it side by side. SC, the automatic reaction. Seller's test in phase B. Getting shoved down for the spring. The second test. The third test. Go. 1, 2, 3. 1, 2, 3. You start seeing it break up and the markup, distribution, all the way back down to where it first accumulated, creating that double bottom for the example here. Let's look at this on a weekly. Accumulation. Notice the lows, the W. Notice the lows. When does buying start coming into play? All in here. The spring up under everything else. This is a weekly long accumulation cycle. It took years. Let's look at it on the 1 minute time frame. Do you see the W? Do you see where price goes right through it? Signs of buying. Then we break out. Accumulation again. Market consolidates. What's it doing when it consolidates? Creating money, creating lows. There's the W. Price breaks down. Spring. And you start seeing evidence of buying. Right now we're on the hour time frame, but it's the same thing right here. Accumulation. All right here. This whole big accumulation phase. Got phase A and B over here. But let's look at this on a bigger time scale. It starts becoming a lot easier on the 4 hour for accumulation. And then on the daily, you can read it a lot easier. All right, you've got phase A, phase B, manipulate down, proof of buying. But when we zoom in on the 1 hour time frame, we can see the accumulation in here. Let's talk about distribution now. Distribution. What's important is being able to understand the highs that they're making with money. Okay, it doesn't have to be picture perfect. But the same way that they run lows before the impulsive move, right? Just look, they did it right here. There's the lows, ran the lows before the impulsive up move. They do the same thing for distribution. The up thrust after distribution. Right? Creating highs. Notice how this high comes above everything else. This is the up thrust. What do you think it's doing? Relieving people's protective stops, activating potential buy stops, trapping and reversing. Then you get the up thrust after distribution, before the impulsive move. This is the only way big money can come in and fill their positions, capturing liquidity, then moving the other way. Let's look at it again. Exact same thing. Highs being formed. Where's the money? The up thrust after distribution, before the impulsive move. Equal highs being formed. The up thrust after distribution, relieving that money. Okay, what I have highlighted is accumulation and distribution. Distribution. Highs being formed. The up thrust after distribution. Accumulation. Lows being formed. And then the spring, right? Because what is it doing? It's reaching below liquidity. Signs of buying. There's the spring. Distribution. Equal highs. The up thrust after distribution. Okay? To keep it simple, the biggest thing is to not have to worry about so much of what's going on in here and here. To keep it simple for you, remember, liquidity is important. But where is liquidity being formed at all times? Liquidity was formed here. Liquidity was formed here. Now the fact that this high was not ran, more liquidity is filled to this upside because it's still on the table versus this just captured the liquidity. Okay, but notice it says SOW in phase B, the sign of weakness, because what is it doing? It's breaking underneath past structure. But why is it doing that, and why did it catapult so much? Manipulation can happen here because smart money will buy to push price higher to distribute more. Notice how it finally up here in the UT goes above those highs, touching that liquidity. Okay, capturing it. Now price breaks down. Where's the liquidity now? Liquidity would be above this high. It would be above all these highs. and it would be underneath this low, and now underneath this low. Then price impulsively moves higher to take this liquidity. And this is when the rest of the shares, contracts, whatever you're trading, get distributed in here. And it's the exact same way underneath. Where does the liquidity get formed? Underneath the SC. Underneath the SC. Then above the AR. And then more over here. And then all of a sudden you've got the liquidity taken. And then the liquidity is taken under here. And this is how the markets move. It's constantly taking liquidity. It's constantly taking out higher highs, higher lows, lower highs. Doesn't matter. It's constantly looking for those pending orders. What are the pending orders? Your stops, your take profits, your buy orders and sell orders in general. But when it's at here, especially when it's even, so much liquidity builds up. So much liquidity builds up, building up, and then the spring happens. And that's when you're looking for proof of buying or proof of selling by the institutional candles, what we teach you guys. Okay? Now, what happens in between can be anything. Okay? And what I mean by happen in between, remember you have the accumulation, markup, distribution, markdown. This can be driven from news. Okay? Now remember, news is not always your friend, and they have their own agenda as well because it's paid speculators. Who owns Bloomberg? Who owns Forex Factory? Who owns CNBC? Who owns Forbes? Who owns any platform that has to do with finance? And what's their agenda? Are they holding any investment? CNBC is a great representation of how they are not on our side. Okay, teaching us how to buy Ripple at all-time highs and sell it at all-time lows. Okay. Remember this. We had accumulation going on for 5 years, 6 years. And then we start hearing about trade wars and, the China trade war and stuff. Okay? News is used at the excuse to drive price. Okay, and one more example, because Brexit's been going on. Here is a distribution schematic, weekly time frame for Euro GBP. Think about all the great things that are happening right now in GBP. Okay, GBP is catching a lot of momentum. Just for this video, we can show it. GBP, JPY, seeing huge gains. GBP-AUD, huge gains. GBP-USD, huge gains. Accumulation. Okay. Euro GBP, that's where the issue is with Brexit. Notice how much volume came into effect, pushing price up higher. Where are they pushing price to? Do you see M? I see M. Do you see M? I see M. Notice how it pushes right up above the last highs for selling off. Notice where it's moving to. Where's the money? Where's the money? Where's the money? Noticing things like this can help you prepare to understand the behind-scenes agenda. Because while all of this was happening, Brexit looks so bad for GBP. After the highs were ran, now everything is great. And so understanding the phases, where we're at in structure, is very important. And you can predict with high accuracy what the underlining objective and agenda is to move price. Because maybe during an accumulation or distribution phase, there isn't anything going on in the news, or maybe it's negative. And then after all of the supply is bought up or sold off, the story flips and the news will be used to move price. Okay. Building a case for a new uptrend. As smart money absorbs the supply, the price will swing, and it tends to be wide. When it appears the markets have been exhausted, we are ready for a possible fake out, fake test. Price will move. Fake out, the spring moves higher. So I encourage you guys to take all of this in, and the biggest thing to go back test is before those huge impulse moves, what equal highs, equal lows, obvious highs, or obvious lows did market take out to free up liquidity and then impulsively move to the next area. My name is Jordan Morgan.